Depending on which news bulletin you're reading or which economist is giving their thoughts, the forecast for the United States suggests that they're going to go into a recession. And in fact, the rest of the world, including Australia, is on the brink of recession. Now, given the ongoing US-China trade wars, the risk seems a little bit more serious recently, and it could have economic ramifications for much of the world. Of course, that's what the doomsayers have been predicting for years. Despite all their economic predictions, despite all the economic turmoil, the world's economy, and in fact Australia's economy, has steadily grown. Australia's economy has grown for over 2 decades. But economies are cyclical, and our economy is not growing as fast as the Reserve Bank would like. And yes, we're probably going to have a recession again. Probably not anytime soon. So to help understand what a recession is, what's likely to be ahead for our economy, what a recession could mean for our property markets in particular, I'm going to have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist for myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes.
There's scary headlines there. Now, during the global financial crisis, Australia avoided falling into recession, but some people have lingering memories, the older ones, people like you and me, but they've got memories of what happened in recessions, particularly what happened overseas, because very few people remember the Australian recession. They remember people losing their homes, long unemployment queues, businesses going broke. And now with concerns of the international trade wars, the Chinese economy slipping a bit, predictions of America falling into recession, stock markets around the world losing billions of dollars in value in just one day, and Australia's economy languishing, some in the media in Australia also suggesting Australia could slip into recession. So let's start with the obvious question, Andrew. What is a recession? What are we talking about?
It's a measure of economic growth, Michael, and it's typically a measure of GDP. And recession is 2 consecutive quarters where GDP falls below zero. So it's 2 quarters of negative growth, and that's a technical recession. And obviously the outcome of 2 quarters of growth has likely been lower employment growth and higher unemployment. And of course, that's the spectre that we're all fearful of, and that's losing our jobs. And it is reflective that previous recession you referred to, of course, was severe in terms of an economic shock in Australia. And it was the most severe recession that we'd suffered since the Great Depression of the 1930s. And it really did cause havoc, particularly in Victoria. And it's something, obviously, that we should rightly be fearful of if it was ever repeated. But that's given the fact that economies change and that it's unlikely to be repeated at those levels that we had in 1990, 91 and 92.
Sure. Well, in those days, the world was very different. Our economy was very different. We had the boom after the 1980s stock market crash. There was a property boom. There was an asset boom. So the Reserve Bank put on the brakes by pushing interest rates high. Inflation was high. Interest rates were around 10%. And we had various precursors that are not there this time round. So what are the headwinds that the Australian economy is facing this time round?
You're right in terms of the preconditions for the recession in 1991, Michael. We had a very sharp stock market decline in 87. The governments reinflated economies, particularly with a lot of easy money. That created an asset price boom. And of course, that meant inflation was rising quickly. And of course, as you suggested, the brakes needed to be tapped. And that moved to the point where it could constrain economic growth, and we ended that recessionary phase. But it's a totally different environment now, of course, Michael. Our problem is our inflation is too low rather than too high. We've moved through a strong period of growth in terms of house prices in Australia, particularly Melbourne and Sydney. That's eased, and now we're starting to recover from that. And our interest rates are the lowest we've ever had and likely to fall lower, according to the RBA, moving forward. I think that if we do move into one of those technical recession periods where growth is negative over consecutive quarters, it'll be a grinding, moribund type of environment for the economy rather than a sharp and steep decline that we saw in 1991. I think the interesting thing in that period, Michael, was that we really didn't see the type of decline in house prices, which has become almost a legend to those that discuss the period 91 and 1990 in terms of its impact on the housing market. In fact, prices through 91 actually increased in most capital city markets. And the peak to trough performance of Melbourne and Sydney, Melbourne prices fell by the most of any of the capital city markets, down by just under 10% over that period. And the Sydney market peak to trough fell by around about 3%. So it wasn't a significant decline over, and that was a period of, in Melbourne's case, 3 years from peak to trough. In Sydney, it was only 1 year. But you've got to remember that prior to that decline in house prices, Sydney's median house price had increased by 80% over 3 years, and Melbourne was up by 55% over 3 years prior to that decline in the price cycle. So it was a very modest reduction, really, given how strong house prices had increased. But of course, again, that reflects the different economic environment of the era, and we're certainly now in a period where we're unlikely to see that roller coaster. We've come through the roller coaster, Michael, and now it's a very flat period going forward, notwithstanding what does happen in the economy.
Sure. Well, clearly Victoria suffered most in that recession in the 1990s. A lot of institutions went under, and a lot of people who had over-leveraged themselves got into trouble during that recession. And that's often what recessions do. They clean out periods of excess, which we have done in a different way this time around, Andrew, which is one of the reasons I'm not sure that we're going to fall into a recession now. But what are some of the economic headwinds that the Australian economy is facing at present?
Certainly, we've seen the end of the construction cycle, Michael. We've got a significant decline in planned activity, both in residential and commercial construction. Consumption, of course, has been the main problem with our economy, and that reflects low incomes growth. And the retail sector obviously is also suffering from low consumption levels, but also from technological change, from online purchasing and the end of bricks and mortar retailing per se. And so all these things are sort of working together to create issues that are likely to cause higher levels of unemployment, which we're sort of seeing early signs of now. But we have the other end of the, the argument, and that is that our export sector is doing very well in terms of mining, and with a lower dollar that will improve our tourist performance. And of course, our education sector is doing very well as well, Michael.
Well, clearly Australia is not working in isolation. Our economy is affected by the overseas trade wars, but I was really happy to hear this week Donald Trump recently tweeted reassuring us. He said everything's fine and we're not going to have a recession, so maybe we don't need to discuss things any further, Andrew. But the good news really over the last little while is employment rose for the 33rd time out of 34 months. In July it did. Jobs increased. There was 44,000 new jobs, 34,500 of them were full-time jobs. The participation rate went up. In other words, more of us are looking for jobs, and I guess that's one of the reasons the unemployment rate hasn't dropped as the Reserve Bank would like. But consumer confidence is there. And as I said, I don't see the precursors to a recession. We haven't had the excessive optimism. We haven't had the boom that you'd normally have prior to a recession. And as you said, global inflation is low. We haven't had a huge surge in debt, as we discussed in a recent Property Insiders chat. And as you say, many of the Australian segments of the Australian economy are chugging along pretty nicely.
At the end of the day, Michael, if we want to, we can talk ourselves into a recession. It's all about that sentiment factor to say, well, look, we're worried about something. Now, whether it's substantial or not, that's a whole other question. And as you discussed, there aren't a lot of signs other than this grinding, stagnant economic environment that most of the world has been in through the GFC period and post the GFC period looks likely to continue, and that is low incomes growth, low inflation, despite reasonable levels of employment and lower unemployment rates. That prosperity feel-good factor is just not working its way into consumption, and it's all about the closing up of borders, whether they be migration or trade. This is what we're seeing as an inevitable result of the lack of prosperity now really worldwide, and whether it works its way into 2 quarters of negative growth, I think will be irrelevant other than creating a few short-term exciting headlines. Certainly, I don't believe it'll have any impact on house prices in Australia.
Well, what you say is that even though we could technically be in a recession, by definition, we've got 2 consecutive quarters of negative growth. That doesn't mean our economy is in tatters. It doesn't mean people are going to lose jobs in large numbers, but it could be almost self-fulfilling, because if there's going to be lots of headlines and the naysayers are going to come out, people are going to lose confidence, and therefore they're not going to buy, they're not going to employ more people, businesses aren't going to take on more inventory, and home buyers probably aren't going to spend a lot more doing up their home or buying new homes. But the bottom line is we are going to have a recession one day, but probably not just yet. That's just the way the economy works. And underlying at the moment, the fundamentals are pretty good, Andrew.
The last time we had a recession, Michael, and they're usually caused by higher interest rates, we had interest rates peaking at 17.5%. 17.5%. Our interest rate currently is 1%. Now, of course, interest rates halved to try to re-stimulate the economy, which they did over a long period of time. But we're in a completely different environment, and unemployment rates doubled as well in New South Wales and Victoria during that recession period. Now, it was a result of those heady days of speculation and easy money, which pushed up asset prices, and was almost an inevitability there. But there are other factors then, Michael. We had moved to float the dollar. We had cut our tariffs down to 5%. There was always going to be an adjustment once the heady days of easy money ended. And that was the, as Mr. Keating said, the recession, in a sense, we did have to work through the adjustments that were always going to end in some sort of a negative outcome as we moved into the real world of market economies.
Well, in summary, our housing markets are probably in the best position they've been in a long time. Yes. To withstand an economic hit. But from the graph you showed us earlier, different states performed differently last time round, and will happen again this time too. Each state's at a different stage of the cycle, got different supply and demand ratios, got different economic factors going on. But I don't think homeowners have got anything to worry about as long as they can keep up their mortgage payments, as long as their jobs are secure. There's no reason to fear a recession. And it's probably not going to happen anyway.
Well, look, Michael, I think one of the most interesting outcomes of the previous recession, the realisation came, Australians will do anything to hang on to their houses. And they did.
And even if there is a little dip, I think we all have to remember that the dips are temporary while the long-term upturn is permanent. So nothing to really fear about, and don't be too scared of the headlines. Thank you very much, Andrew.
Yeah, don't talk yourself into anything, Michael.
It's so easy to, isn't it? That's right.
Yeah. Stop reading those papers.